Hi, everybody. Welcome back to 10 Minutes with Griffin. I'm your host, Griffin Bridgers. For today's episode, episode 146, we're going to talk about completing IRS Form 6252. This is the form that's used when you sell property but carry the note and have an installment sale obligation for income tax purposes. And what this form is going to allow you to do is reconcile the portion of each installment that you receive over the years between the taxable portion and the portion that's treated as a tax-free return of basis. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. Now, ultimately, the end product we want here is the gross profit percentage. That's really going to be a division of your gross profit by the contract price, and then that'll give you a decimal that's multiplied by each taxable installment. And Form 6252 is going to allow you to determine each of those taxable installments. Now, generally, there's going to be three categories of income spit off of Form 6252 that'll carry over as appropriate to the 1040, the personal income tax return. The first will be any depreciation recapture, which is ordinary income, whether that depreciation recapture is deferred or later accelerated, maybe due to a related party sale. We also might have capital gain, which gets carried over to Schedule D, and then maybe income from sales of business property that gets carried over to Form 4797. Now, there might be interest on an installment obligation. It might be stated or unstated under the income tax rules, but that interest will be ordinary income and isn't reported for or accounted for on Form 6252. So you might need to get into whether you have OID reporting or anything like that, but that's a separate subject not related here. Now, before you go down the rabbit hole, you need to determine whether you need Form 6252 in general. Now, first off, a lot of people tend to not necessarily address this, and I've seen this specific error on a number of tax returns before. But before you fill out this form, you need to confirm whether the purchaser is a regarded entity for income tax purposes. So if you have an installment sale for a sale to, say, a grantor trust or a disregarded entity such as a single member LLC, there's going to be no income tax event here. The sale is going to be disregarded for income tax purposes. Now, later on down the road, if you have a situation where a grantor of a trust or the owner of the disregarded entity dies during the tax year, then the sale is treated as if it takes place at the time of death. So what you do is complete Form 6252 for the year of death, as if the original sale commenced on the date of death. Next, you have to determine if you qualify. So there are certain sales that don't qualify for installment sale treatment. One is any sort of dealer or inventory disposition. In that case, it's business income from sale of property. Similarly, you can't sell marketable securities and get installment sale treatment. In that case, you wouldn't file Form 6252. You just report the gain normally on your income tax return. Next, if you're selling depreciable property to a related person, you generally wouldn't qualify and shouldn't file Form 6252. The rare exception might be, for one, if you have property that's part depreciation recapture, then the other part may be 1231 gain or other gain on the sale. In that case, you could carry it over into Form 6252. Another situation would be sometimes if you can substantiate that the avoidance of income tax was not a principal purpose of the sale to the related party, you wouldn't follow within this exception either, and you would be able to use the installment sale gain reporting. Finally, if you're electing out, you're not going to file Form 6252. Electing out is if you choose not to use installment sale reporting of gain. In that case, you just report the gain normally as if you had sold the property in exchange for cash in the form of a promissory note. And then finally, determine if there's a loss on the sale. And if there is, you can't use installment sale treatment, and you must recognize the loss in full for the year of sale. So we start out of the gate determining the property that was sold, and note that you have to use this form for each sale or disposition of property, including in a sale of business. You would have to use this for each sold asset within the business, even though the sale takes place under one contract. You'd also note the date acquired, date sold, and also whether the property was sold to a related party. If so, we're going to jump to part 3, and we'll look at that in a little bit. Now, line 4 rarely applies just because after 1986, you can't sell marketable securities to a related party. So, whether you need to complete part 3 or part 1 first is its own question, because they have some interrelated parts. Especially in a situation where you need part 3 because of a property being sold by a related party, i.e. a second disposition for the tax year of filing here. So you may want to file or complete part 1 first just to get the contract price, because that'll carry over some. And if there's depreciation recapture on the sale to the related party that might get recognized in that year, it doesn't come into play here. You'd end up carrying that over to part 1. Now, here's part 3, and note that all we're really concerned with here on on line 29 is whether or not there was a second disposition, i.e. did the related party sell the property during the year? If not, you don't really need to worry about the rest of this part. If so, then there's going to be certain things that come into account. First, you're only going to have to accelerate the lesser of your contract price, or whatever the seller or the related party sold the property for on the second disposition. You're also going to take out any payments you already received. Those are reported on part 2 during the year. And also depreciation recapture, which will carry over as ordinary income from part 2, and may also increase basis under part 1 as well. Then finally, your balance is going to be multiplied by your gross profit percentage from part 2, and that'll carry over to Schedule D or Form 4797 as appropriate. And then finally, if you have any unpaid installments, if for example the contract price from your first disposition to the related party exceeded the sales price that the related party was able to fetch on the second disposition, you'd still have some excess installments that carry over to later year returns. Now, jumping back into this, part 1 is going to be concerned with determining the gross profit, but not the gross profit percentage. So this is really going to be reconciling basis for use in part 2. So we're going to start with our selling price, and you'll see that lines 6 through 13 are really geared towards determining basis, and then ultimately lines 14 through 16 are designed to subtract out any other gain exclusions and then determine your gross profit and then your contract price. So what's the difference between the two? Well, really the difference between gross profit and contract price is going to relate to your basis, which is adjusted in lines 6 through 13 with deductions for your beginning basis, depreciation deductions for the year of sale, and for any assumed debts. And then you're going to add back in commissions and sale expenses paid by the seller and any depreciation recapture that you have to recognize in the year of sale, if that can be deferred, or if there's any gain portion that's getting deferred here. Now, on line 15, if you have the gain exclusion for a sale of principal residence, you're going to take it out, and ultimately you'll end up with the gross profit percentage. But where things get really kind of weird is in a situation where any debt is assumed in connection with the sale by the acquirer, the purchaser. In that case, for one, starting out with a selling price, you're going to take that out in determining your adjusted basis, and then add it back in if the debt assumption is less than your adjusted basis ultimately determined. And really what that does is it tracks the rule of cottage savings that says that assumed mortgage or other debts are going to be treated as cash received and your amount realized. And then finally, when you have your gross profit and your contract price, you can divide the first by the second to come up with a decimal that's multiplied by each installment received during the tax year to determine what portion is taxable versus what portion is a tax-free return of basis. So you'll see your gross profit percentage is going to be simply dividing line 16 from part 1, the gross profit, by line 18 from part 1, which was the contract price. And then for the year of sale, You're going to carry over any debt assumption that's treated as cash received on line 20, and then also bring in any payments during the year for later years, and then lines 20 plus 21 times the gross profit percentage is going to be your installment sale income on line 24. You'll note on line 23 we account for any prior year's payments, but we don't need to really take those into account here. This is just an accounting mechanism. Then once you have the installment sale income, you can divide that out into the ordinary income portion on line 25 for any depreciation recapture, or the capital gain portion for the sale of a 1231 asset on line 26. So remember at the end of the day that what you end up with here is on line 22 really just the total payments times the gross profits percentage to give you the taxable portion. And then the balance that's left over from each payment is going to be a tax-free return of basis. But you're not done with just this return. You have to carry over the results to Schedule D or to Form 4797 or just to your Form 1040 as ordinary income as needed. Hopefully that helps you with the completion of Form 6252. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. Thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.